Happy Friday, trading family. We survived the week, Kospi didn't know what hit it, and Apple just became the most crowded sale on earth. Quick reminder before we dive in. Nothing we say is financial advice. Do your own research before you put a dollar anywhere. Two guys yelling at charts. You know the drill.
Standard disclaimer. We're just talking markets, not telling you what to buy. Your trades, your responsibility.
Here's the whole show in one sentence. And we mean this one from the heart. If you only look at the headlines, the market went up. If you look at what got bought and what got sold, it went sideways scared.
That's the frame. Let's start with the number that broke the internet. Kospi, up 17.91% in a single session.
17.91. SK Hynix, up 25%. Samsung over 20%. Best day on record for both. In the same week, they crashed. 4 sessions ago, July 28th, Hynix fell 15% in a day. Margins accounts in Seoul got absolutely mowed.
And here's the plumbing. Korean retail doesn't trade stocks, they trade leveraged semiconductor products. REC shares said it. 20% of their assets trace back to Korea, and 65% of Asian trading venue revenue is Korea. These are the most levered, most crowded, most emotional trades on the planet.
So what happens? Microsoft rips 16%. Amazon drops a capex bomb after hours. And that same crowd that got liquidated 4 sessions ago re-levers into the exact names that just destroyed them. 17.91% isn't conviction, it's a margin stampede in both directions. But here's the threat to the whole party, and it's not in Seoul, it's in Tokyo. TV, you got the handoff.
BOJ held rates at 1% overnight, 8-1 vote. One board member wanted to hike to 1.25% right now. The warning was blunt, core inflation running clearly above 2%. They named the reasons. Wages getting passed into prices, oil, and the weaker yen. That's not just a war story, that's a wage story. We're coming back to that.
And then Tokyo did the thing. Suspected yen intervention overnight.
Exactly. The yen strengthens, and that's the cold water on the whole Korean trade. The yen is the pipe that feeds the leverage. Cheap yen funding built the pile, and a stronger yen pulls the pipe out. Same crowd that just stamped into Samsung on Thursday gets margin called again, and 17.91 can give back half in a session.
So the real question isn't just, does Korea hold it? The question is, does Tokyo let Korea hold it?
That's the carry trade danger in one sentence. And the other side of this rotation just did something very weird. Apple, ticker AAPL, slipped after hours to about $320 on earnings that were fine. Not spectacular, fine. Q's is sitting around flat, while the same artificial intelligence names that crashed 40% are ripping for record days. Microsoft had its best day since 2008, 16%. Amazon, with a capex monster. Semis roaring in Asia. That's not a market, that's a rotation.
Rotation needs fuel. So where's the fuel coming from? The safest, most defensive, largest company on the planet just got turned into an ATM.
Look at the internals. Small caps are red. IWM down about 1.15%, while Q's sits flat. Bitcoin, the purest liquidity gauge, is down 3.5%. If real risk appetite were back, Bitcoin would be green. It's red. That's the tell. This bid isn't new money. It's existing money getting pulled out of the safe stuff and shoved into the same crowded trade that tried to kill us all on Wednesday.
Money's not hiding today. Money's chasing. That's not risk on, but the narrow squeeze wearing a rally costume.
And the sector board proves it. Consumer discretionary, XLY, leads the week up 5.3%. Staples, XLP, up 1.2%. Financials, the financial sector, up 0.8%. Laggards, utilities, XLU, down 3.75%. Industrials down 2.24%. Real estate down 2.21%. You're selling defense and buying leverage. That's exactly the fingerprint of a rotation, not a broad rally.
Our TFT algo had Apple, stock got tagged this morning. That's what stops are for. Take the loss, move on. But the trade tells you the market's mind. Defensive quality is getting liquidated to fund the fever. We called 2 markets on Monday, and today they're fighting each other inside the same sector.
And I put on a small Apple long this morning, my paper account, $2,000, stop at $295. It's a knife catch thesis. The opposite of the momentum chases that burned me before. If PCE prints hot and the rotation unwinds, Apple is the bid. If PCE prints cool, a dip on fine earnings mean reverts. Defined risk, sized small.
I said earlier, I wasn't catching that knife, but that's a real trade with a stop below the intraday low. My paper is holding oil, not Apple, but I see the whole setup. 2 books, 1 tape.
2 books, 1 tape. Now let's talk about the clock, the Fed and the PCE tiebreaker. This morning's wage tape, labor costs came in hot minutes before the open. You saw front-end yields lift in real time. That's the freshest fact we have, and it says the inflation fight is not over.
The Fed held Wednesday. 3 dissents. 3 people voted to hike now. Warsh stood at the presser and said basically nothing. Bloomberg called it a harsh verdict from Wall Street.
And then Friday morning, Hammock and Kashkari publicly break ranks. On a Friday, before PCE prints, they say hike now. That's not a quiet dissent. That's an open letter.
Dudley dropped the line of the week. You can't outsource policy to markets because markets price what the Fed will do, not what it should do. The market wants a cut. The data wants a hike. Warsh can hide behind unity talk, but his own members just blew that up.
And the private credit market already outvoted him. Fitch said the private credit default rate hit a record in the second quarter. Tightening is transmitting. The crack shows in credit before it shows in equities. Warsh can outsource policy to markets all he wants. Private credit just told him policy is already biting.
So now we've got the tiebreaker at the center of everything. Core PCE prints today. Consensus is 0.2% month over month, 3.3% year over year. That's double the 2% target. The bond market is pricing one thing, the stock market another. PCE is the decider.
Quick global snapshot, Bank of England held at 3.75%. German CPI ticked up to 2.7%, and Eurozone GDP came in flat. But the main event is that PCE number. If it comes in hot, the bond trade wins and the Fed credibility crisis gets worse. If it cools, the rotation gets a second wind.
Which brings us to the reason the whole thing is happening. Clergy. Chevron reported profits up 400%. Adjusted earnings per share 606 versus 556 estimate. Exxon same story. Combined, the 2 oil majors quadrupled profits.
And the backdrop is darker. Egypt has been pulled into the war for the first time. The Strategic Petroleum Reserve is at the lowest level since 1983. Oil is sitting around $85 with Hormuz traffic recovering, but still at only 30 to 35% of pre-war levels.
Chevron CEO Worth said, the world is running out of time. The war premium isn't a headline. It's structural. And this is the spine that connects everything. War is the inflation story, and the inflation story is the Fed story.
But before we get too comfortable with the long oil thesis, remember, oil geopolitics is our measured blind spot. We've overcalled floors and war risk premiums before, and the tape just ground lower. The counter case is that de-escalation whispers or demand erosion erode the premium. I'm not fading your trade, but I'm giving the invalidation level, our stop.
That's fair. My gut call account, my personal paper, is holding the energy sector, ETF. Entry 5694, now at 5887. Stop at our stop. I'm not adding. I'm selling the supply premium, not the position. The moment the war premium turns into a bull trap, I'm out. But for now, the structural story is intact.
And that's the hot theme touching your book. And it's the same theme that makes the PCE number today either a confirmation or a reprieve. No other earnings scream loud enough to move the needle. So energy and the E in PCE are the same story.
Here's what we're watching tomorrow. Number 1. Core PCE print later today. Hot equals bond market wins. Maybe unwinds the Apple knife catch and hits our energy thesis. Cool equals rotation, gets a green light, and the artificial intelligence chase continues.
Number 2, my Apple long, stop at $295, size small. If that level breaks, the knife catch failed, and I'm out.
Number 3, the energy sector, ETF, stop at 54.30. If crude gives up the war premium, the whole energy thesis flips.
And number 4, Kospi overnight. If the yen keeps strengthening, that 17.91 gain could give back fast. Seoul's leverage party has a Tokyo hangover.
2 books, 1 tape, that's the whole show. Markets don't sleep, but we do. Catch you Monday.